Today is the 14th of February, and globally, this is a very interesting day when everybody is saying love is filled all over in the air. And so as we say, love is all over in the air. Some are receiving flowers and chocolates, and there's an aura of excitement about love. However, from Octagon Africa, what do we have to offer you? We'll offer you some virtual chocolates. I hope you can receive our virtual chocolates. We have virtual chocolates from the Cadbury, Ferrero, Raffaello, the premium chocolates. Over to you. Elizabeth, if you can tell me, is your mouth watery at the moment?
Very much, very much. I'm wishing you could send them over to me.
Wow, wow. Don't worry, I may not be able to be at the doorstep of each and every one of you this morning. Nonetheless, I am certainly sure that we want to have a discussion this morning beyond chocolates. Let's take a moment and just think about the chocolates and what we really experience when we actually buy a chocolate bar, open it up, and throw a piece of chocolate into our mouth. It's actually watery, and our mouth is filled with a particular experience that possibly words cannot be able to explain, but it's sweet and nice. And therefore, in a short while, the watery feeling quickly disappears down the esophagus to the stomach, and we quickly forget the experience. But as we quickly forget that experience, for those who are chocolate lovers, they will keep remembering that actually I've just eaten a chocolate. Whether it is today or a few days down the road, sweet truth will always remember. For the ladies who value chocolates, I'm sure once you're given a chocolate today, you'll be rejoicing and saying, the love of my heart remembered me today and not only give me flowers and love, but also offered me a chocolate bar. Therefore, we have come to learn over time that there are people who value chocolates. But at the same time, we know there are others who do not actually value chocolates. You give them and they're wishing, I wish you bought me an orange, I wish you bought me a mango, because they are not a sweet tooth and they don't value chocolates. So if you're that type, please bear with some of us who love chocolates, and we journey together with you this morning as we talk about beyond chocolates. Love is not just about that mouth feeling experience that's watery, juicy, and sweet. Love goes beyond that moment of feeling that I am happy with you, I'm excited with you. Love goes beyond that part. And that's what we at Octagon Africa want to bring at the comfort of wherever you are, to actually talk about beyond chocolates, so that we can build a lasting love with some financial security. What saying and what exactly do we really mean? I want to take you to journey together with me. I'll do a very simple introduction in terms of our career life cycle. Then after that, we will ask ourselves, now that we are living life together, or we are going to live life together, how are we going to live beyond chocolates, beyond that bubbly feeling, beyond the warmth of love? How are we going to live beyond that? And therefore, we'll do a bit of budgeting together this morning. We'll also talk about saving so that we can know our different modes of saving. And we'll also talk about debt management. And as we handle the saving and debt, we must also secure our financial security in the age beyond 60, and therefore a bit about the plan. In terms of the career life cycle, I'm sure a couple there, and this, they are looking way ahead. They have begun the journey together. They could be in their 20s, they could be in their 30s or in their 40s. Regardless of where you are, you have begun a journey together with the love of your life. But in your career, you are also aiming not to stagnate at the starting point, but you're aiming to actually walk the career path and grow in terms of your career path. And therefore, your success is your goal definitely, and is our goal, as you're saying that. If you can see on the top right, there's a very interesting picture there, which I actually want to really explain just a little bit. There are guys who have actually climbed up the first staircase, and they are very elated that they are on top of the staircase. They actually have a kite, and the other one actually is having some pair of binoculars, just checking how far they have gone in their career. And the one with the kite is already celebrating. They feel that they are at the pinnacle. There are others down there, they are beginners in their career, and they are wondering, which side do we go? Do we go the side of the pink staircase? Do we climb up this ladder and start getting more ambitious? Because there's a higher staircase right above the pink one. And you can see that as the ones who are already on that other staircase, they are very ambitious. One is holding a bulb and saying, I really must get up there. And the other one is a lady struggling to take strides of, I think, 5 fleet of staircases. I don't know how possible that is in terms of our career growth, whether we really grow exponentially like the way she's too ambitious to actually get up there. There's another one right at the pinnacle and has sat there, and they are feeling, I have actually achieved, and here I am. They are jubilating. They are celebrating where they are at. We all desire that we can grow in terms of our career. We all desire that we can grow in terms of life. We all desire that we can grow in terms of even our marriage growth. So growth is very, very necessary in all angles. And because today we are talking the language of love, we just do not want to ask ourselves, are we growing in the spheres of love? But we also want to ask ourselves, are we growing in our career? And as we grow in our career, of what value add is it to you and your spouse? Of what value add is it to you and anybody surrounding you that you consider that they are part and parcel of your love life? So that's what we want us to ask ourselves, how we are going to build a lasting love with financial security with these people who are very close to us. And I want us then to ask ourselves, now that life is in seasons and a series of steps and different experiences, like I have just described the photos that we have seen, and we are in a journey where we want to attain step by step a definitely new experience of what we have. We need to ask ourselves, how are we going to come up with a more coping mechanism that is very, very necessary for us to have a quick turnaround in terms of our finances, in terms of growth in life, regardless whether it's career growth or any other growth in life. I want us to first think about life in seasons. And remember, once we were at childhood stage, now we are all at adulthood stage. Soon, we'll be senior citizens and we'll get to the golden years. And when we get to the golden years, whatever we have done during our adulthood stage is what we will depend on when we become senior citizens in the golden years. And that is what will lay a foundation and a background for our future. And that is what we want to discuss today. So why do we plan for finances? We actually need to plan for our finances because we want to ensure that when we get to the golden years, we have a foundation, we have a background, and we are safe. So we ensure that we have a safe nest even while we cruise through life right now as adults. In case of an emergency, you have a fallback. Or should you lose your job, and God forbid, but it actually does happen, companies are forever doing restructures, what would happen to you? Then would you have a fallback in terms of finances, or immediately you fall out of your job, you would then be penniless immediately? We need to ensure that we plan our finances so that we ensure that when emergencies crop up, we are able to cope with the situation. We also need to plan for our finances so that we meet our desired standard of living. I mean, how you were brought up in your childhood, when you flash back, Possibly as an individual, you tell yourself, I would maybe want to lead a better life, or I would want to benchmark the life I've been brought up with. It all depends with our backgrounds. But it's very, very important that we ask ourselves whether we are planning for our finances to meet our standard of living. And therefore, it's important. Sorry about that. I forgot to actually put my camera on. And there I am. That is Florence Mushiri Kobuthi. Sorry that I forgot to put my camera on. So as we're planning our finances, we are also planning so that we meet our desired standard of living that we all have. We also need to plan our finances so that we can diversify our investments. The Englishman said, do not put all your eggs into one basket. And therefore, in terms of finances, you cannot afford to have money just go to the bank account only. That is putting all your eggs in one basket. We will see there below how we need to diversify our investments, because I'm going to talk about that so that we can build a lasting financial security. We need to plan having a good career. And as we grow in terms of our career path like we began, it means that even our pocket, our remuneration, our take home actually improves as we grow our career. So a good career planning definitely will lead to financial wellness. If you don't do a proper career planning, you stagnate. And if you can remember the photo that I began with, there were two people right at the bottom at the beginning point. You stagnate at that particular point. So it's important to also do good career planning so that you grow. As you grow in terms of your career, you're financially stable, and it of course leads to financial wellness. Definitely, when you plan, you have financial freedom, you get a peace of mind, and you'll not be engaged in the rat race. So let's understand our cash flows first before we even go any further. Where do your cash flows come? Our cash flows is money coming in, money going out, and principally, it's important that we identify any leaks that come into play in our life so that we can quickly close those leaks and plug them appropriately. And we'll be able to see how the leaks come in, because we are actually going to look at that. And therefore, we need to ask ourselves, what is our net worth? And we are asking ourselves in terms of assets, what are assets and what are liabilities? I want to quote Robert Kiyosaki. He said, assets is what brings money to your pocket. And he also said, liabilities is what takes money out of your pocket. So today we'll look about our assets, and I want us to think about what we commonly call the poor man's cash flow. The poor man's cash flow, and I'm hoping that my audience are not in this category, but should you be in this category, that is why we are doing the training. The poor man's cash flow is one who has no assets, they have no liabilities, and their source of employment and employment alone. And when it comes to their expenses, once they receive money from their salary, they actually expense it, and they expense it in terms of the basic needs, and we'll be able to see that as we are budgeting. I have an example about a poor man's cash flow. Then there is the middle class person cash flow. They still do not have enough assets. They have plenty of liabilities, the middle class, a lot of liabilities. They have taken a mortgage, so they have a house, they have a flashy car, or if not a flashy car, at least they have a machine that makes them move from point A to point B. They could be having credit cards and several natures of borrowing. So in terms of liabilities, they have several liabilities. And the majority of them, I'm not saying all of them, but majority of them, their source of income is purely employment alone. They have other expenses that purely remain the same. How about the rich person's cash flow? This one is slightly different, because when it comes to assets, the rich person's cash flow they have a lot of assets, loads of assets. They have assets in terms of stocks, they have assets in terms of bonds, they have real estate. You find them, they are owning probably some few rentals, they have intellectual property. And when it comes to liabilities, they operate on cash on delivery, COD. So all the time their purchases are cash. That is the rich person's cash flow. Then in terms of their source of income, it is heavily diversified because they have incomes from interest, the dividends, they have incomes from rental and several other modes of income. So that rich person is the one then who can define for us what it means to say that I am wealthy. The more one earns, the wealthier one is. So wealth is a function of savings and not earnings. And if you forget every other thing that I have spoken today so far, please remember, wealth is a function of savings and not earnings. And therefore, being wealthy is to having substantial assets and resources beyond just money. While being rich, it means you have a high income or some large sums of money at any given point in time. So there's actually a difference between being wealthy and being rich. So I will dive into personal financial planning. You're going to look at budgeting. I'm done with the introduction. We're going to look at our budgeting. We're going to look at the savings component. And in the savings, I'm going to combine savings with insurance because of time. We're going to look at debt management, and we're going to look at the retirement planning. So when you're budgeting, do you ever, for a moment, sit and have a budgeting document? Do you have a book? Do you take your calculator? Or do you walk into the supermarket and just do your monthly shopping, and you do not even have a list of the items that you actually want to buy? If you do so, you end up getting into the supermarket, you'll end up doing something we call impulse buying. When it comes to budgeting, it's important that we remember we must live within our means, that we must not spend beyond what you intend to spend or beyond what you earn. Back to my example in the supermarket. Whenever you get to the supermarket, you have a figure of how much you want to spend your shopping with, or you just shop, wait till you get to the cashier, it's billed, and you pay. It's important we budget, and we budget each and every thing. So it calls for us to make a list of all our income streams, and we also factor our expenses at the same time. We can factor our daily expenses, we can factor our monthly expenses, but it's important that we do that, such that when we do that, we are able then to come up with cutting down what is unnecessary. If you have some expenses in your list that are not a must, maybe they are wants and not a need, then you are able to deal with those expenses and remain with what is really, really necessary. And then as you prepare, then you must also consider, if you're married, you must consider your spouse when preparing a budget. If, and more so, if both of you do have an income, it's important that then you factor that and be able to consider how much are you shopping out of the incomes that both of you earn. So arm yourself with a planner, and then as you do that, you must also remember that as you budget, you must put some money aside. They actually say that you must put 20% aside for savings, so that you ensure that you are not spending your entire earning, but you are putting money for other investments through savings. If you have dependents, you must make sure that you take care of your dependents. And this is where we talk about the insurance component. That's why I said, as I was diving into our real topic, I said the saving and the insurance component, I would handle them together. So if you have dependents, ensure that you get some life covers for them, some medical covers for them. For a child who is going to school, get an education policy for them, so that you then diversify and put your money into different portfolios. It's also important to always be ready with any time we may meet our maker. So part of budgeting and planning financially in life, is also important that we write a will so that we keep our hard-earned money within the family by putting our desires and our wish. Allow me to dive into the budget itself. When I have someone earning a salary of 70,000, and I have two scenarios here. I have scenario one and I have the second scenario. The first scenario is where the person lists all their needs in terms of basic needs, what we really call the real needs, the food, the clothing, the shelter, the medical, and they actually factor it per day, per week, per month, and also annually. And we can see the figures there below. And let me go to the column for the per month. Out of the salary over 70,000, this particular person has actually consumed about 40,000, and therefore they have a surplus of 30,000. However, there is scenario two, same salary, but this particular person in scenario two, besides the basic needs, if you go there below, they are actually at the same time saving in different models. Scenario one, they have no saving component other than the 30,000, which we do not know whether this person leaves the 30,000 in a bank account or they have then gone and invested elsewhere. But in scenario two, this person has invested elsewhere, and you can see that actually they are at 103,320, meaning they are actually spending beyond their earning, and they have a negative 33,320. Could you be in scenario two? Could you be in scenario one? The one in scenario two is a real sad state of affairs because I do not know how they eventually are able to bridge this deficit of 33,000. But they have done better than scenario one in the sense that they are actually saving in terms of pension. They do have a car, yes. They are actually paying for a mortgage. They have an insurance and they love themselves. So they actually also factor for holiday and travel. Well, that is good enough, but they ought not to still live within beyond their means. So possibly scenario one, they may not be telling us where they are taking the 30,000, but at least scenario one, they've tried to live within their means. And I want to trust that in scenario one, that 30,000 is not lying idle in a bank account, and that it is actually being invested in diversified ways. If you are in scenario one, kudos for you, because today we shall learn where we need to take that 30,800. If you are in scenario two, we need to do a bit of financial wellness to massage you to live within your means. However, we are happy that you also have some model of saving, but we need, as much as that saving is there, we need to patch up that scenario and have something different. So I want to talk about how do we deal with a lean path. And I have some 7 elements of how we do with a lean path. And that is where I'm laying a foundation about how we save. You must first start fattening your path. And this is where you must then differentiate between your needs and your wants. In terms of needs, is where we are talking about you need it for the purposes of survival. And we always say that needs are limited, and it is something that you must have. It's essential for survival. Needs more often than not may remain fixed, and they can't be postponed. It's a do or die. The needs, we are talking about things like food, clothing, shelter, health, education. Those are needs. But in terms of wants, it's what we talk about, quality of life. So you must first start differentiating. If we go back to scenario two, I won't go back to that screen side, but scenario two had holiday and travel. That's a want. So it's important that we cure it in terms, when we check at our lean pass, we must ask ourselves, is this a need? Is this a want? Before we spend. And we must spend less. We must spend within our means, and we must ensure that we save at least 20%. We must control our expenditure. We have looked at the budget, so I will not labor more from that. We must our ability to earn. We have actually savings mentality. They are earning from different elements. They are earning from rentals, they are earning from dividends, they are earning from interest, and therefore it means if you're salaried, there are different ways that you can earn by investing today, making sure that the money you earn makes money for you in return. You need to guard your treasures from losses, and that the losses are in many angles. And it's not just about money being stolen, it's about habits. Are you a spendthrift? If you're a spendthrift, that's one way of losses. If you do impulse buying, that's another angle of losses. If you flash money out because you want to please people, that's another way of losses. So losses are in many different angles, and we need to guard our treasure under all means and under all costs from any losses. Then it's important that as we are growing our career, it's important that we aspire to own a home and own one in good time. It is a profitable investment. It is a profitable investment. Do not own a home at the verge of for retirement. When you're just about to retire, that's the time you're like, I need to have my own home. It's important to budget early enough and start owning your own home. Hence, scenario 2 may be slightly better than scenario 1 because they have a mortgage and therefore they have a home. It's important to start planning about that and planning it early. We must ensure that our future, we plan it. I'll emphasize that later on. And we must ensure that you make your gold multiply for you. So how is our gold going to multiply for us? We must dream big in terms of our savings. If you dream big in terms of your physical outlook, or in terms of the car you drive, or in terms of the estate where you stay, remember, we'll be at the middle class mentality, and we want to go to the rich person's mentality. So we must dream big, and in our dreams, we need to dream in terms of how are we saving, and we must set goals. And when we set those goals, we must take action. We are in February, and we thank God that today we are celebrating Valentine's Day. The other day, we were saying Happy New Year. Now we are celebrating love in the air today, and we are telling each other, beyond these chocolates, how are we going to save and acquire financial discipline? We set goals in January. Have we moved a step or an inch? You may have set a financial goal. Where are you at? Or you set it and you haven't taken action. It's never too late. We can take action today. So we must start saving as soon as possible. And you must treat your saving as something very, very important. The way, if you are renting, you must pay rent. And you do not want stories with either the agent or with your landlord. You must ensure that you pay rent. That's the very same way that we must be disciplined to ensure that on a monthly basis, 20% of our salary goes to saving. You can save in different modes. You can save in the pensions. You can save in the life insurance. And remember, when you save in pensions and life insurance, you enjoy some tax benefits. And right now, everybody is feeling the pinch with the finance bill about the new taxation level. At least there's somewhere you know that you can get some tax relief through saving pension schemes and also the life insurance. So let's get to the different levels of our saving. And in the different levels of saving, I want to ask, what are you investing in to make your goal multiply? Different kinds of investments. We have the fixed income mode of savings, and this is diversified beginning from the bank all the way to the private companies to the government. We have call and fixed deposits. These are mainly in the bank where you walk into the bank. So scenario one, the 30,000 that scenario one is holding could have an arrangement with the bank that this money, whenever it comes at the end of the month, I would want this money fixed. It's fixed. The bank gives you an interest rate, and on a monthly basis, the monies are billed based on interest rate, and at the end of the term, then you are given your 30,000 as the interest rate. Fixed deposits can be for 1 month, 3 months, 6 months, and 1 year. They are short-term kind of investments. Once are fixed, should you go for your deposit before the term is over, you can lose the interest component. But if it's on call deposit, just as the word reads, it's money on call. Should you require it at any time, you can go for it in the bank and you'll be given your money plus the interest that's on call. Then we have what we call the equity side of investment. And then we also have the debt portfolio or debt instruments other than the cash instruments. Debt instruments are things like commercial paper and treasury bills. Commercial paper is issued by corporate organizations. Treasury bills is money issued by the government. The difference between the two is where it's coming, but the operation is more or less the same. For commercial paper is where a private company or a corporate is in need of either a particular project or funding for whatever reason. Reasons can be varied and can be many, and therefore they float a commercial paper. Treasury bills is issued again by the government, and this is because the government has different needs. For instance, infrastructure, the roads, health, very many different needs, and therefore the government floats a treasury bill. Both the commercial paper and the treasury bills operate in a very similar model, whereby you do not pay the entire amount, and that's where we talk about the funds being discounted. And as the funds get discounted, you will get a particular interest rate. So for example, if the government has floated a treasury bill, you have 1 million which you want to put in the treasury bills, but the rate has been offered 10%. So 10% of that 1 million, once you remove the 10% of the 1 million, you will pay 900,000. Then when it actually matures, upon maturity, and we have different days, we have 91 days, we have 182 days, and we have the 364 days. Once it matures, that is when you get paid your 1 million. Remember, you paid money less the percent, the interest rate that had been offered. But upon maturity, you'll be paid your 900 plus the interest, and therefore it gets loaded and you get the entire amount of money. And that's what we say at par. You'll be paid at par. So that's how the commercial paper operates, issued by corporate companies, and that's how the treasury bill operates, issued by government. We do have the debentures and treasury bonds. Debentures, again, are issued from the corporate space, from the private company, and the treasury bonds from the government side. For this, they operate more or less in a similar model. And again, it's a debt instrument where you are funding either the company or you're funding the government for the government to do whatever project that they do have. In terms of this, there's an interest rate, but this interest rate, they actually do not call it interest rate, they call it coupon. And as they call it coupon, you are paid this interest rate after every 6 months. So back to my 1 million example. So if we have invested $1 million, we'll be paid after every 6 months the interest rate, that 10% after every 6 months. This is long term. It's not short term like what we have looked at. This is long term. It can go between 5 years, 10 years, some even go to 30 or 40 years. So it depends with how long it is. The beauty about these instruments, as much as they are debt instruments, they are actually, you can actually trade them such that if the coupon is for 25 years, for example, and you feel you do not want to stay with these treasury bonds for that 25 years, and you actually want to trade it, yes, you can actually trade it, buying and selling that takes place in the stock market, at the rate that you will get, and you can be able to trade them out. So that's on the fixed income. Let's talk about the equities. In terms of equities, here we are talking about the stocks, or what is commonly known as shares. And these again are cash elements, just like the way the call and fixed deposits are cash. These are cash you trade in the stock exchange. And we have the listed and the unlisted. The listed are those shares that have been listed in the stock exchange, but the unlisted are shares that have gone out into the public. They've been issued publicly as shares, and there are companies that have done that, issued them publicly, but they are not listed in the stock exchange. While you are investing in equities in that space, it's very important to do your due diligence regarding that company before you actually get into that particular space, to be able to be sure that the company is stable even as you buy their shares, especially for unlisted stock. We have offshore investment, which takes the form of bank deposits, the government securities that I've spoken about, which are the treasury bills and treasury bonds, and quoted as securities, which I have just explained. We also have investment in property, and investment in property, we have the REITs, or property where you actually purchase some property to later dispose after speculation, or to later invest in that property. We have pooled funds, and in the pooled funds, these are funds like guaranteed funds or the segregated funds, or the mutual funds. In the guaranteed and the segregated funds are funds in an insurance company, but the mutual funds are funds that the insurance company can also ride on the mutual funds, but we also find that with private firms that are dealing with the space of finances, and there are very many companies of that nature. The beauty is that in the pooled funds, you definitely get somebody who walk a journey with you to actually let you know where to put your pooled funds, whether guaranteed or segregated or mutual. They all carry different levels of risks, and therefore it depends with the weighting of the risk of what you really want, but somebody can guide you through. We have alternative investments, and in alternative investments, those above investments that I've spoken about, we do have private equity and venture capital that I have not talked about, besides what is above them. In the private equity and in the venture capital, you'll find that private equity is where investors could be looking for a company to invest in, and invest in terms of cash investment, equity itself, to be able to boost the company for growth. And on the end return is that they will definitely be aiming to make some level of return on their equity. We also have venture capital. On venture capital is for startups, where a company wants to start up and you're looking for a partner that you can get into a joint venture, and they can fund the project, and that is what we call venture capital, that you'll really find in alternative investments. We have also derivatives, which work very closely to something like the debentures that I explained earlier, and the alternative investments, and that means they relate to the corporate space. So allow me to quickly go through about how do we get into debts. We get into debts when we spend more than we earn, and that means we are not saving, and we want and we also engage in other things that pull us into debts. We have good debts and we have bad debts. Good debts are debts for investments. I've explained about some of the debts in terms of investments. And some of these are also things like loans where you are buying shares of a business or something, or mortgage or a car loan. Bad debts are debts for consumables, where you are actually borrowing so that you can consume. That's a risky debt. In my Kenyan market, that has become a very, very common debt, and especially with the mobile space, the fintech companies and several mobile loans, people have really tied themselves into this, and therefore, how do we get out of bad debt? We need to manage we must plan before you borrow, and you must budget. And remember, we have really emphasized about budget. As you borrow, ensure that you only tie a third of your income into loan repayments. Do not be scenario 2, where they had tied more than what they are earning. It's important to always be within a third, so that 2/3 you are able to be left with 2/3 to engage in terms of either debt investments or equity investments and your expenses. You must avoid borrowing for consumptions or for given goods. Things like holiday, those who borrow for holiday, if you borrow for furniture, it's important to now pause and know that is a bad debt that you must manage. You must avoid impulse buying under all means, and you must avoid what we call savior mentality, where you are saving the life of everyone, including your family members, and you are there, you are the sponsor, sponsoring them, as the word is commonly used, but used in a negative connotation. Here, I'm talking about where you're sponsoring people so that you can fund their life and their lifestyle. And it's important to know that as you do that, you are tying yourself into debt. So in terms of managing your debt, you must first prioritize your payments, and therefore the budgeting component of having a list comes in. And if you have a loan, like I said, you must budget even for a loan. You must pay your loans as fast as possible. The longer you take in terms of a loan term, the more interest you pay, the more the loan becomes expensive. So if you can pay your loan in the shortest time frame, it then becomes less expensive, and you are relieved of that debt, and you are able to move on and do other things. If it is school fees, plan to pay your school fees in installments so that you don't tie your finances all at once. You must avoid something like a credit card under all means. This is one of the most expensive borrowing. And I always tell people, when the banks are selling this product, they'll tell you the card attracts interest at 3%. What they are not telling you, it is 3% per month. 3% times 12, we are talking of 36%. You can go and do the math. If it's a loan that you borrowed at 36% per annum, that's a very expensive debt. You must ensure that you manage your family and your friends. At times, these are people who are very, very close to us, but they take us into debt. So it's important that you balance in life. Tell yourself, beyond the chocolates, beyond loving family, beyond loving friends, I must manage myself and my finances. Now, allow me to quickly dive into something. I'm sure you can see a gentleman there. That gentleman has practically no hair. His head is almost bald, but he's clinging onto the table and has refused to actually leave the office. And he's actually being told, look here, everybody has to retire at some point or another. But they are clinging in there. In my community, the Kenyan community, if you are Kenyan enough with me, I'm sure you know one or two. What did they not do? They did not plan for retirement. So why should we plan for retirement? We must plan for retirement because as we age, our physical body caves in and requires a lot of medical attention. And therefore, we need money to pay for the medical side of it. If you want to live a longer duration and you want to live happy, you must ensure that you save money in the pensions. Octagon Africa, that's what we really deal with. We are pension administrators, as Elizabeth introduced, and we are here for you, and you can talk to us and we can be able to engage you in terms of an individual personal pension plan for pension. We can also be able to engage you and your company in terms of occupational or a corporate standalone pension scheme. We can also be able to engage you if you are an SME in terms of pension for the umbrella scheme pension scheme, so that you take care of age 60 and above. You take care of your medical expenses. You take care of inflation that can erode any benefit that you can be given while going home. So it's important to know that we need to plan. And as we are planning, let me give you statistics. According to Retirement Benefit Authority, who is our regulator, the statistics show that very few retirees live comfortably after they retire. 47%, almost 50, depend on relatives. And this is in Kenya, my country, your country, depend on relatives. Then we have a whole 31% who, after they leave retirement, they start looking for other jobs to do. They are working and not their own personal business, jobs in a formal office. They are holding on, like the answer that we have just seen. They are holding on 31%. Then we have 16% that are dependent on pension. Those have got it. I hope you can be a statistic in that purple arena, the 16% that are dependent on pension, and 6% are financially independent. I hope you can also be in that 6% that we call the rich, if you can remember what I spoke about, the rich. And what are the misconceptions about retirement? Many people say it's not urgent. It's not for me, it's for the elderly. They believe that the family will take care of them when they retire. And for those who have children, they're looking at their children like their pension investment plan. Others, the pension is meant for people who are employed. So it's not for us who are in business. It is also for you in business. And that's why I have an independent pension plan. Others feel that saving is a complex matter, and they are thinking, how do I be deducted a whole 20% of my income, and they are struggling. Talk to us, work a journey with you. And others are feeling that pension is not an investment vehicle. A survey was done a while back, and someone 25 years said, I am too young to think of pension. Then another one who was 35 says, I'll think of pension when I hit my 40s. Then another one was 55. They said, I should have started this 20 years ago. Then the one who was 75, they said, I wish I started when I got my first job. And guess what? In the Kenyan news, at the comfort of my house, one evening, NTV, they talk about this 73-year-old man who went to High Court to compel his 48-year-old son to relinquish 20% of his salary for his upkeep. I hope you will not be like this 73-year-old man. Therefore, planning and saving starts now. And it starts now, and it starts with the person in the mirror, so that beyond chocolates, we can dance our life out and say, life begins at 60. Thank you very much. And I, Florence Mushiri, Commercial Director at Octagon Africa, wish you a happy Valentine. Thank you. Questions?
Thank you. Thank you so much, Florence, for that wonderful presentation. We've truly learned a lot, the difference between wealth and being rich. I thought it was the same thing. Glad to know, and how to fatten my past. But before we go into what I've learned, I see there are already some questions in the comment section. For those who haven't asked their questions, please type in the comment section, and Florence will be able to address each and every one of them. So I see Agnes, for her, it's a comment. She says, this is great. I must start treating my saving as a necessity. And then we have a question from Rachel Mothoni Mwangi. She says, what are rates?
Okay, REITs is an acronym real estate investment trusts. Real estate investment trusts. And REITs are in two components. If I would just explain it a little bit, this is where you get a company that is investing in terms of houses, and therefore you can either buy the shares as they are investing in houses, like the affordable houses component, and not the ones that are government related. I want to give like the ones that have been done for Kwetu with QWETU. I know it's a particular company. I'm forgetting the name of the company that has done those hostels that are actually used by mainly university students or people in college. And it's a concept where you can now buy the shares, real estate investment trust. So you can buy the shares themselves, and therefore you start earning from the kind of income that they generate through that model of investment. Then there is the other end, where other than buying the shares, you can become the owner yourself. And then after you become the owner, you ensure that then you register for the real investment trusts for people to then also be able to partner with you in that particular model. Thank you for that question, Rachel.
Thank you, Florence, for that answer as well. So I see Agnes, she's saying that the savior mentality is what is ailing me. I see a couple of people who are asking for the slides. Definitely after every presentation, since you signed up, we have your email address. So after the meeting, feel free to check your emails. You'll be able to get the slides. Thank you for an amazing presentation. Thank you so much. So thank you, Lillian and Rebecca, for your feedback. I see a question from Lillian. She says, I would like to understand the difference between treasury bills and treasury bonds. How do you earn interest on both?
Okay. The difference between treasury bills and treasury bonds, one critical difference is that the treasury bills short term. They are short term. The treasury bonds, long term investment. That is one difference. Difference number two is their mode of operation. In the mode of operation for the treasury bills, we do have 91 days, we have 182 days, and we have the 1 year days. So in the treasury bills, they operate differently in the sense that they are discounted. That's what I explained, that they are discounted. And when we talk of discount, the treasury bills have offered a rate of 10%, and you want to invest 100,000 into the treasury bills, you will not pay 100,000. You will pay 90,000. The 10%, which is now 10,000, is what is discounted. And when that gets discounted, it means you'll be purchasing the treasury bills at 90,000. And then once you do that, then at the end of the 91 days or the 182, or if it's for 1 year, at the end of the term of the treasury bill, you will be paid your principal capital that you invested, which is 90,000, plus the interest that you had been promised, which is that 10%. So you will get back your money. The 100,000 is what you will definitely get. Any other return on investment gets loaded onto that amount, but you must get the bare minimum of 100,000. So even if then there wasn't any other return on investment on this 100,000, at least the 100,000 you must get it, not but 100,000. That is treasury bills for you. Then the treasury bonds, the ones that we said, they are long-term. On the treasury bonds, again, it's still government securities. You trade this with the government. And let me go back to the 100,000 example that I have given. So in the bonds, you will utilize the whole 100,000 to put into your investment. And remember, both treasury bills and treasury bonds, they are debt instruments. We are loaning money to the government to be able to do whatever project they are doing. So you give the government this 100,000 as a whole. Then when you give the government the 100,000 as a whole, they have told you the interest rate is 10%. They actually don't call that interest 10%. They call it coupon. So when you hear the language of coupon, don't think it's so technical jargon. It is just the simple term, layman language, interest rate. So they'll pay you a coupon of 10%, and this coupon is paid after every 6 months. So after every 6 months, you'll be getting 10% of that 100,000. So this government bond was going for 5 years. So it means that you'll be paid a coupon 10 times because each year you are receiving it twice after every 6 months. So after the 10th coupon, after the 5 years are over, you will be given back your principal amount of 100,000. So it means that the coupons that you receive, those 10 coupons, that is your return in investment, which you get within that duration. So that's the difference between the treasury bills and the treasury bonds. It's in the mode of operation and it's in the duration, but both of them are debt instruments lending to the government. Thank you. Back to you, Elizabeth.
Thank you for that detailed explanation. We have a question from Milka. She says, I would wish to ask on individual pension scheme, does it have a predetermined rate in terms of interest, or what determines the interest rate?
A lovely question. On the individual pension plan, you contribute as an individual any amount that you so desire to actually put on the individual pension plan. When we receive it, it has been licensed by the Retirement Benefit Authority under what we call umbrella scheme and the individual pension plan. So once we receive the funds do not stay idle with us. Definitely the umbrella component, the umbrella scheme component rides on what we call a pool of resources put together, a pool of funds put together. So your IPP plus my IPP and the other person's IPP, when they are pulled together, we have a pool of funds. And now from this pool of funds, we definitely must invest this money because we must grow your money. We do not want you to give us 10,000 and then when you come for it, you receive it back as 10,000. We want to bring your 10,000 when you come for it. We've grown this money and you receive it back as 14, 15,000, that we have grown your investment. How do we grow these funds? We grow these funds through diversified portfolios. Octagon Africa, we are pension administrators, and therefore we rely on the people who know how to do this work, and those are fund managers. So we do have fund managers in place who invest the pool of funds in different diversified portfolios. And those are the portfolios that today I was privileged to quickly take you through in terms of the different levels that we can save in. So we invest in the government bonds, we invest in the government, in the treasury bills, we invest in shares, we also invest in the segregated, we'll invest in the guaranteed. It's a whole bouquet of different investments. Why do we diversify this? It's a requirement of the Retirement Benefit Authority that this must be done so that we can cushion volatility, or we can cushion situations where the one particular portfolio may not be doing very well. For instance, if the shares are not like right now, the treasury bills and the treasury bonds are doing very well, then we can be able to cushion the losses and the interest, and at the end of the day, when you come for your 10,000, I'll have grown the money. Thank you very much.
Thank you, Florence. We have another question from Delvin. He's asking, what time do they take to update our monthly payment? I believe he's a member here.
the monthly payment is talking about the contributions,
Yes.
which one receives the monthly contribution, we actually update it immediately. And as a member, you are able to log into OPAS. OPAS is Octagon Pension Administration System. You're able to log into that system. And if you do not have login credentials, please get in touch with us to be able to activate and get you login credentials, where you can log in and you see your monthly statement and you can see your contributions. As we receive them, we post them immediately. At Octagon Africa, we leverage on technology and we ensure that we update the contributions immediately. And especially if it's an individual pension plan, we'll be able to see it immediately. If it's coming from your employer, once we receive the schedule, we'll upload once we are cleared off internally. And that means that at the end of the month, you can be able to see your contributions.
Thank you, Florence. We have another one from Andy. He says, while investing on money markets, etc., is it possible to get information from CMA on the products they have covered instead of relying on company agents who are after sales?
Wow. You must have gone through a particular experience for you to actually ask that, because I know there are many financial organizations definitely looking for sales, and as they look for sales, definitely they have their cut or their cake in the process. In terms of dealing with the Capital Markets Authority directly, that I am not 100% sure, but I'm not seeing a challenge on that. I need to quickly ask before we end up this meeting. Elizabeth, any other question?
Yes, we have another question from Delvin again. He's saying, what are the benefits we get from our contributions?
The benefits you get from the contributions are diverse, because one critical benefit definitely is the interest that you actually get. And other than the interest that you get, the return on investments that you get, another benefit is we can, once you come for your package, so benefits, there are things that you can purchase, which we call like annuity, sort of a salary for those who are proceeding for retirement, or an income drawdown, which again adds value for those who are proceeding for retirement, or a post-medical cover, which adds value to anyone proceeding for retirement, post-retirement cover. So these are some of the things that will add value when you actually come for your pension benefits. All these products, we actually purchase them through a reputable insurance company, and we'll get varying quotes, a minimum of at least 5, be able to, then you can then take a note and say which insurance company you desire to go along with. And then you can be able to enjoy further benefits beyond pension month. You can then be to enjoy on a monthly basis different kinds of services. Thank you.
Thank you. We have a comment from Lois. She says, thanks for a great presentation. Indeed, it was eye-opening. Then Delvin has another question on what are, he says, explain to me, what are the managed funds?
Managed funds, that came in alternative investments, and managed funds, we would treat them like what I had spoken about, pooled funds, only that these managed funds are offshore, on an offshore basis, and therefore not local, but another term of pooled funds, and of course operating on offshore basis. And I had explained about the pooled funds, how it's either segregated or guaranteed, and the pool maybe give a little bit more information. It is where you find that either multiple individuals or multiple employers put money for investments, and these investments is not in a particular scope. It is actually diversified and spread out in different ways. And that is why under alternative investment, they're calling it managed funds, because it actually gets then managed by, of course, a fund manager or a fund expertise, and they diversify them into various asset class portfolios.
Thank you, Florence. So we have another question here from Thomas. He says, thank you for the presentation. On the option of saving through insurance, what solution would you give a person who can no longer afford the premium anymore?
Wow. So they can't afford the premium anymore. So how are they saving? That's I believe it's just about talking to the insurance firm. That's step number one, because it's a premium you definitely have contributed to the insurance company, and that means then you need to let them know that you are not able to pay. Based on the insurance and based on whatever cover it is, they will manage to let you know what needs to be done. And why I'm saying this is I am cognizant that there are some covers that you could have taken and you're not able to pay. So they let you know, we won't refund you the money, allow the funds to stay with us until this cover reach its maturity. And upon maturity, they are able then to refund back to you the money that you contributed plus a return, because they actually invest the money. It does not lie idle. So that's an issue or an area that you would need then to consult the insurance themselves, and they are able to guide and let you know what needs to be done. But basically, that is normally what happens.
Thank you. We have another one from Joseph. He says, the treasury bills and bonds, how accessible are they? Is it something you just walk in and transact your business?
And bonds, you know, participate in them individual yourself directly. You can use a fund manager. You can use the financial institutions that actually do that kind of work, the companies like the Kusas of the day and the like. However, when you handle it on an individual basis, you need to get it. I know before CBK went to the technological space, we had the CDS account, which is now virtual. It's DOE CD something, DOE. So you need to get into the system and put through an application. And once you find your bio data, you must also furnish them personalized for you, and you must also provide your identification document, which is your national ID. So after filling in the application and providing your biodata and attaching these attachments, you upload and immediately to CBK, who then thereafter they are able to respond back. And once then you do have the account to let you that this is your account that you can trade with in terms of which then the treasury bills and bonds, then you start tracking them in the system to be able to participate in that system. There's so much on that CBK website that you to get into and see, and then can be able to participate. It's not automatic again, that once you
sorry to catch you, Florence. Florence, sorry to catch you. You're breaking. We're losing you. I think your internet connection is unstable.
Oh, so excuse me. I've spoken a lot about the treasury bond. application. I repeat the whole of it.
Yes, because you were breaking. I also see some comments here from some members who can't hear you clearly.
Let me repeat again. I just said that the treasury bills and bonds can be purchased as an individual and also purchase them different financial institutions that are in that space of business. However, I was giving the details of if someone wants to purchase them as an to do is get into the CDS account that you need to actually open. They now call DOCD something. Then you fill in the application. Once you fill in the application, you must upload that application. They'll guide you how to upload the application. Attach a passport size photo, and you must also attach a copy of your ID for identification after filling in your biodata. Once it's received on that end, an account gets created and they share the account with you. Once you get that account detail, that's the account that you will be trading in whenever you want to then invest in either the treasury bills or the treasury bonds. And once you do that, whenever you participate in the bidding process of either the bills or the bonds, then it's not that you pay. You must actually wait for a node, which they actually do again online, and give you the details of where to put the payment into, the account details, where to actually then deposit the funds for whatever, either the treasury bill or the bond. It is that simple when you are participating in it as an individual. Previously, people used to go to work in CBK, but now in the space of technology, we are in the technological space. Thank you, Liz.
Thank you, Florence. We can hear you better now. So I have a question from Milka. It's a very good question. She says, thank you for your feedback. I am a member and planning to transfer my pension to the individual scheme. Please expound on the interest rate. What is the current return rate? And is there a minimum rate guaranteed?
Okay. We haven't declared our rates for 2024, which definitely we are going to declare before the end of this quarter. However, currently, I would want to talk about the average in the industry. The average in the industry, as it were, you find between 8 to 10%. That's the range that I would talk about in the industry. As at Octagon, I would talk about at that 8% itself. The previous year, 2022 was an election year, and therefore the average in the industry had gone down. It was not at 8 to 10. The average actually was at around 6%. At Octagon, we were at 5.4%. So that's the average that I would talk about. When you are asking, is it possible to get a guaranteed rate? Yes, it is possible to get a guaranteed rate, and that is where then you let us know, so that then you can then go for guaranteed funds as opposed to segregated funds.
Thank you, Florence. We have another question from Rachel. She says, thank you for the insightful presentation. One last query. Can you tell us about infrastructure bonds?
Infrastructure bonds are bonds like, for example, roads. That's a perfect example of infrastructure bonds. Power, Kenya Power. Those are infrastructure bonds. Anything to deal with the solar projects that the government is doing, the geothermal, those are infrastructure bonds. So it's a bond in terms of basically infrastructure, just like the word reads. So when a bond, whatever bond it is, it should come up with its name. However, it basically means exactly what the word states. So when it's infrastructure, just think in terms of infrastructure, connectivity, and opening up. I hope I have
Thank you.
answered the question.
Thank you, Florence. We have another question from Lily. She says she's a pension contributor through her employer. Kindly advise on other saving products you have as Octagon.
Octagon Africa, we are administrators, so we can basically talk much about the pension space, where we have different kinds of pensions. We also are an insurance brokerage, and from the insurance brokerage, we then deal with different insurance funds for their varying insurance products. But over and above that, we do not have any other saving product that we can talk about as Octagon Africa. Being pension administrators, we are highly regulated, and RBA is our regulator, and therefore we cannot operate beyond our scope of operation as per regulator. So any other mode of saving, as I have explained it, will either be in the banking circles, will either be in the corporate world, or it will be in the government space, and varying different products, which we cannot manage because we cannot regulate what is not within our space. Our space is purely pensions.
Thank you, Florence. I'd like to let Milka know that we'll also reach out to her personally on the individual pension plan. I see also Andy wants to learn more about insurance covers that one can take after retirement, showing premiums payable and the coverage. We'll be able to send this to you on your email and start the conversation from there. Then we have another question from Jackson Omamo. He says, thank you for this great presentation. What is the performance of REITs in high inflation scenario? Is the rate on Kenyan market currently outperforming other similar investments?
The performance on REITs, to be very honest, in Kenya, is a model. The example that I gave for the Kwetu, that's the only model that has definitely worked. REITs haven't performed very well in our country. However, when you do a study out there are countries where REITs have been such a huge success story. And especially in developed countries like in Europe, a number of countries, REITs have been a success story. In Africa, South Africa has been a success story in REITs. But Kenya, there's something that we may not have hacked it. But I think, pleased to let you know that as much as we may not have hacked it, the REITs Association of Kenya have, last year they did a major conference, because getting back to the drawing board in terms of how do they reinvest this model differently. And I know there's a lot of work that was put into space last year. And I believe that definitely it will take a different shape and a different model. And especially seeing what has really sold out in Kenya is the Kwetu model, then that's a concept that they want to take a notch higher to be able to take the REITs in this country into a profitability level, into breaking even, and into making money for the investor. So if you have engaged in REITs before and you've burnt your fingers, hang on in there, because I am certainly sure that definitely it will be different, especially from the lessons that they have learned from Kwetu.
Thank you so much, Flores. This was such an insightful presentation. We've gone 29 minutes from the time we were supposed to end this meeting, and this is because of the wonderful information that you're giving us today. And I want to say thank you for such a wonderful presentation, and to our members, thank you for joining. I hope you really have learned a lot. And as we conclude, I'd like to read this comment from Ogwindo. He says, thank you so much. Thank you for such an amazing presentation. I wish you could advise our government on how to manage debt, as they seem to borrow to pay previous loans or to consume by paying salaries. I am a humble beneficiary of a 20-year journey with Octagon Pension Scheme. Thank you. Thank you so much, Ogwendo. We really love to hear these positive experiences you have with us. Florence.
Yes, it is. It is. Thank you so much for that beautiful compliment.
So Florence, any last words?
Yes, I have a last word. And the last word that I have for each one of them is that beyond the chocolates, let's build lasting love and financial security. Happy Valentine to each one of you.
Thank you. Thank you so much, Florence, for that wonderful session. I see, Andy, you want this session to be repeated. Don't worry. We are going to send you the slides to your email. We'll be in constant communication with you. You'll definitely hear from us soon. And I know you wanted a plan on the insurance. We'll also be able to get back to you on the same. You remember that you sign up to these presentations using your email address. But if you need to get into contact with us by any chance, you can always write to us at training@octagonafrica.com. I'll put down the email on the chat section, but be sure that you're going to hear from us soon, if not today, by tomorrow. You'll be able to hear from us and we'll be able to keep this conversation going. So I also want to wish you a happy Valentine's Day, and even as you spend the day, is as you go on spending, remember we've been taught to control our expenditure. The plan is to keep our pockets fatter. So thank you so much. Thank you so much, Delvin. We'll keep talking. We always have these sessions every second week of the month. So I hope we'll be able to see you next month for another amazing webinar. Thank you so much for joining. It was great having you. I wish you all a blessed day. I'm typing in the email which you can reach out to us, and we'll be able to answer any queries that you may have. Training at Octagon, for those who are writing down, training@octagonafrica.com. Thank you so much. God bless you. Have a wonderful Valentine's. There you go. The email address is on the chat section. You can write it down and, feel free to leave. Thank you so much. See you again next month for another insightful webinar. And also invite your colleagues and your friends so that they can be able to learn as well. We do this for free because our mission is to guarantee your financial security. Thank you so much, Mary. Thank you all for your wonderful feedback. We are glad you learned so much from this session.